A company can lose money, fire people, and still make investors richer. How can one company lose billions yet its stock still rise? Most people assume stock prices move based on profits. So when they hear a company lost billions, they expect the stock to crash. But stocks don't price the present. They price expectations, narratives, and future control. Once you understand that, this confusion disappears. 10 reasons a company can lose billions and still see its stock rise. 1. Stocks price the future, not current losses. Markets care far more about where a company is going than where it is today. If investors believe losses are temporary and future profits will be much larger, the stock can rise even while current numbers look terrible. 2. Losses can signal aggressive growth. Many companies intentionally lose money to expand faster, capture market share, or dominate an industry. Investors often reward losses if they believe the spending creates long-term monopoly-like power. 3. Revenue growth matters more than profit early on. For growth companies, rising revenue shows demand and scalability. As long as sales are growing rapidly, investors may ignore losses because profitability can be turned on later by cutting costs. 4. Cost cutting can improve future margins. A company may report losses while restructuring, laying off workers, or shutting unprofitable divisions. Markets see this as short-term pain for long-term efficiency and reward the stock in advance. 5. Expectations were already worse. Stocks move based on expectations, not headlines. If investors expected massive losses but the company loses slightly less than feared, the stock can rise because the outcome was better than expected. 6. Accounting losses do not equal cash losses. Some losses come from depreciation, write-downs, or one-time charges. These reduce reported profit but may not affect real cash flow. Investors focus on cash generation, not accounting optics. 7. Dominance over profitability. Companies that control platforms, data, or ecosystems are valued for power, not profits. As long as control strengthens, losses are tolerated because future pricing power looks inevitable. 8. Central bank liquidity lifts all assets. When interest rates are low and liquidity is abundant, investors chase growth regardless of profitability. Cheap money allows loss-making companies to survive and thrive in stock markets. 9. Stock buybacks and financial engineering. Companies can support stock prices through buybacks, restructuring, or balance sheet optimization even while core operations lose money. Markets reward shareholder-friendly actions. 10. Narratives move markets more than numbers. Stories about innovation, disruption, AI, or future dominance shape investor belief. When the narrative is strong, markets overlook losses. When the narrative breaks, prices collapse instantly. Final truth. Stock prices don't measure business health. They measure belief in future power. That's why a company can lose billions today and still rise tomorrow.